Many stocks got battered last year. Is now the time to buy them? The pros reveal their picks for the year ahead.
Ryman, I would say, is a sort of long-term structural call with significant upside in the near term as well. A2 is probably slightly more opportunistic. So, basically the price is low, fundamentals have improved, and both macro and micro. And the market is giving Ryman pretty much zero credit for that, as far as I can tell. So I would say it's one of the best 2 or 3 opportunities in New Zealand in 2024.
It's Friday, the 2nd of February, and you're watching Markets with Madison. The pace of inflation is officially on the way down, and interest rates are expected to follow, meaning this could be the year for the NZX to show off. And it could do with some growth after only returning 2.6% last year, compared with the Nasdaq's 43% boom and the S&P 500's record highs in the past couple of weeks. But investment analysts believe opportunity is available locally, as some of our companies are massively undervalued. Here's the stocks the pros are picking will do well in 2024. Infrastructure investor Infratil is a crowd favourite again. The owner of Wellington Airport and 1NZ keeps increasing the value of its stake in Aussie data centres, the most recent repricing at around $4 billion. Property is making a comeback, featuring in 4 out of 5 firms' picks. Retirement village operator Somerset well liked because of its financial discipline. Rival Ryman Healthcare and hospital owner Vital Healthcare all featured too. Sky TV's share price is expected by a few to rise, as its turnaround strategy targets a doubling of its dividend in 3 years. With so many power companies on our exchange, one was guaranteed to be picked. Contact Energy is expected to benefit from renewable energy investments. Another defensive play is Spark. The telco consistently delivers on earnings. The wildcards include insurer Tower, which had a rough year last year with costly weather events. It could be taken over this year. And there's A2 Milk. It's struggling with a shrinking market in China, but its brand awareness is apparently strong. Transport operator Freightways is another turnaround hopeful. If the economy rebounds, it should get busier. And the only small cap on the list, AFT Pharmaceuticals, may make waves in the US market. Aaron Ibbotson from Forsyth Barr is the one backing AFT among some other stocks. Hey Aaron, Happy New Year. How are you?
Very well, and Happy New Year to you as well, Maddie.
Thank you so much. It was an awesome break. I'm sure you have one too. You're looking a bit tan. Now, look, I want to talk about last year before we get into what we can expect for 2024. Last year was a pretty poor one for the NZX Top 50, especially compared to anyone who may have been in on that magnificent 7 ride in the US markets. Can we expect more disappointment generally for anyone banking on our market to do better?
Well, I think, last year, the NZX sort of suffered from 2 things. I think one of it was starting valuation, which was quite high. And the second was interest rates going up, and we got a very interest rate sensitive market effectively that sort of held back a lot of large cap names. Going into next year, I think it looks a little bit better in our view overall for the New Zealand market. When we look at global versus New Zealand, our view would probably be that it looks a little bit better internationally still than it does for New Zealand, but maybe not to the same degree as we saw last year.
The trends that really took over last year, as you've mentioned, interest rates, inflation, obviously too, but also things like weight loss drugs, and tourism had a really good year locally. Are we expecting any of those trends to still be in this year, or are they largely out?
So I think, it's the real trends, and then it's how market interprets the trends, So I think the real trends will continue, AI or artificial intelligence is a massive trend that's going to continue in the real world for decades. No doubt, inflation will be important, but I think, or weight loss drugs or this GLP or GLP-1s. But we think that this year is going to be a lot less about, what I would call hype cycles, short or longer term, and much more about, valuation and genuine fundamentals, So for a few stocks, to take NVIDIA as the obvious one, this AI is very real. for a lot of other stocks, it's more of a multiple expansion than actually impacting their earnings. So we're calling it a bit of back to basics in 2024.
So pretty much the year of value this year then. How can investors identify that value? What sort of stats should they be looking at? Should they just look at price to earnings, or is it more about the undervaluation of companies and their share prices?
You know, it's normally a combination of different things, to be honest. And, you know, I guess it's with anything, it's, you know, a multiple of things, but I would say three things, broadly speaking. So when you're trying to look at valuation, or at least we look at relative to history, relative to peers or equal type companies, or, you know, on a first principle. So, you know, a DCF or dividend discount model or something on a first principle basis. So, you know, the easiest is probably, as you highlight, you know, you look at something like price to earnings ratio relative to history or relative to peers. That's probably a good sort of starting point. And I think in the New Zealand market, you know, how we think about the next year, you know, some of our really, you know, high quality growth companies, and particularly in the larger cap space, so say a Fish and Paykel or a Mainfreight or an Ibbotson, I'd call them probably fully valued, or you know, at least not on a meaningful discount. So when we look at sort of the biggest opportunities, we're looking maybe outside of those. And the other area is on the yield sort of or infrastructure part of the market. And again, you know, which we've talked about before, in that area, you know, we see, broadly speaking, the valuation being pretty full. So in cyclical or in growth names outside of those sort of 2 or 3 top names is where we see the most value.
Yeah, on the ones that you like, you're pretty bullish on Ryman Healthcare this year, which I'm going to say I'm a bit surprised by because you haven't always been kind to the stock. About this time last year, it had that big mea culpa where they announced that near $1 billion capital raise, completely admitted that they'd taken on too much debt, even though you'd been telling them that for a while, Aaron. Why are you all of a sudden optimistic on Ryman?
Well, you know, when the facts change, I change my view, I think is the answer. So I think 2 things, major things have happened. Well, I would say 3 major things have happened with Ryman over the last, call it 2 or 3 years. So number 1 is that the valuation has come down quite dramatically. So on most metrics, it's halved. And in some metrics, it's gone down even more by, you know, a factor of 3 if you look at price book, for instance. And the second thing that's changed is, you know, Ryman has totally changed their focus. You know, they've been extremely focused on growth at all costs for many years. They have, as you pointed out, largely ignored the buildup of debt. And ever since the capital increase early last year, they've been very focused on cash generation, which has been not just mine, but several us who have been a bit critical of Ryman over the last few years. You know, our bugbear effectively that they haven't really focused enough on cash. They're very focused on cash. But the third thing is that fundamentals have changed. You know, so house prices, after having been under severe pressure for 2 years here in New Zealand, you know, it's not bullish or anything, but it seems distinctively normal if you look at what's happening in the housing market at the moment. Turnover is relatively normal. Prices is creeping up slowly. And if you look at care funding, another big area for Ryman, it's been basically disastrous for 2 or 3 years where funding hasn't kept up with costs at all. And then the last funding round was good, not fantastic, but good. And finally, maybe on staff and staff costs, you know, you've had really high staff inflation costs for the whole aged care space. And that's dramatically slowed down with the opening up of the borders. So, you know, basically the prices is low, fundamentals have improved, and both macro and micro. And the market is giving Ryman pretty much zero credit for that, as far as I can tell. So from our perspective, you know, we like the aged care sector overall in 2024, but Ryman is our top pick. And, you know, if I look at all the different variables, I would say it's one of the best 2 or 3 opportunities in New Zealand in 2024.
Other firms also do see this property cycle re-emerging, but they're not picking Ryman. Some of them are picking Somerset, another retirement village operator. And I also saw that one picked Vital Healthcare property, which owns private hospitals, as you know. You don't think that those are a better pick given Ryman's history?
I don't think they're a better pick. I don't think there's necessarily a bad pick. If I pick up Somerset as an example, Somerset is a great company. They've executed very well, no doubt of it. And as you know, we've been very supportive of them before. So I think the main question for me with Somerset relative to Ryman is number one, valuation. Somerset on my preferred metric, which is something I called EV to annuity, EBITDA, annuity earnings, which excludes development gains. Somerset is on maybe a 30-40% premium to Ryman. I put them on the same multiple. So that's one thing. And the other thing I think with Somerset versus Ryman is, Ryman has a lot more developed business in Australia, but we're neutral on Somerset, but I think it's a great company, and I'm sure it could perform well as well. A rising tide lifts all boats. On Vital, I think broadly speaking, again, we're not negative on Vital, but if you look at the REIT sector overall, it is much more interest rate sensitive, and it doesn't look particularly attractive to us on valuation, that whole sector. It doesn't look as bad as it did 12 months ago, partly because interest rates have come down a little bit and partly because the shares have come down a little bit. But, compared to Ryman, where, we can see, I don't want to put any numbers out there, but we got meaningful upside on a 12-month view, and we can see it continue after that as well.
So you're effectively a man out there looking for a bargain. Is that also why you like A2 milk? Because it's cheap?
Well, yeah, A2 milk, Ryman, I would say, is a sort of long-term structural call with significant upside in the near term as well. A2 is probably slightly more opportunistic, to be fair. But again, similar to Ryman, the market has been very harsh on it over the years. We quite recently upgraded it to buy. And the key reasons here is, partly you've seen a big adjustment in multiple and share price over the last couple of years. And partly, again, coming back to this hype and reality is like there's absolutely a demographic issue in China at the moment with fewer babies being born. But again, it seems like maybe the market has got ahead of itself a little bit, assuming that, there's never going to be a rebound. And similarly, if you look at sort of brand metrics or A2 milk's ability to take market share in China, they are actually taking a little bit of market share. If you look at some of the brand metrics that we track from various sources, it's actually is improving a little bit. Margins are improving a little bit. They've also got a couple of loss-making businesses. I don't like adjusting for this and that, but if you do, the stock is on 15 times. That is quite a low multiple for a sort of very high quality consumer staple brand.
If you're interested, I did do a big episode on A2 last year, so worth a watch, Aaron. Now, one thing that we also saw a bit of last year, and there was certainly a bit of noise around it at least, takeovers. Pushpay left the market, it was taken over. Sky TV was in apparent talks late last year, but then sort of canned all discussions before we ever found out who that mystery potential bidder was. There's also talks of Tower Insurance. It's undergoing a strategic review, so it could maybe leave the market if it decides to be bought out as well. Should investors be looking for those sort of plays this year, for stocks that are cheap and could be potential targets?
Yeah, absolutely. We think M&A will be a sort of theme this year, and it's driven by a few things, I think. But the main thing for me is just reduced uncertainty. So if you go back a year or even over the last 3 years, 4 years, it's been a lot of uncertainty, not just interest rates and inflation, but the whole COVID lockdowns. You've had massive uncertainty around macro, some wide ranges of forecasts. And this year, for the first time in quite a while, even if interest rates are still much higher than they used to be, people are quite comfortable where they are. They don't look like they're going to suddenly go up a lot. So that we think will be the main driver of M&A. And when you look at, it's very difficult to go on a single stock and be like, oh, this company will be bought. You know, if that was your view, then the stock would have already moved. But the way we try to think about it is groups of stocks that could be exposed. And how I like to phrase it, more than, you know, you should buy these M&A potential, is more like you should be a little bit careful being underweight this whole group. So, and I think, you know, there's different things to look at. You look at some companies which are very low on a price to book multiple, you know, so for instance, that generally attracts buyers. Some of them have very, you know, and I think, you know, there was some noise around an Arvida bid as well late last year, and that, you know, I would assume is sort of attracted by trading on something like half-time price book at the time. Other areas is high free cash flow yields, and you talk about Sky TV. You know, for sure, Sky TV trade on a free cash flow yield, which, you know, in the good old days, or in the old days at least, that would have been you know, absolutely attracted a lot of buyers when you see free cash flow yields, you know, 8, 9, 10, 12%, because they can fund it. You know, even in today's interest rate environment, they can fund it. And others would be strategic, you know, and we haven't seen a lot of strategic M&A for a long time. You know, these are bolt-on small companies with a strong position in certain areas. You know, you mentioned tower, so, you know, I don't know specifically on that one, but that's probably, you know, a company that could be interesting from, you know, large corporates who want a foothold. But there are others, you know.
We'll watch, worry, and wait, won't we, Aaron? Plenty to come this year. Thank you so much for your insight. Appreciate it, as always.
Thank you. Thank you for having me.
Now, you didn't think I was going to let the pros have all of the fun this year, did you? I'm about to reveal my NZX top 50 picks for 2024. But just to make it fair, we're doing it a bit random. This isn't official, but my producer Kane is about to tip some companies on my head. I'm only going to pick 2, and then we'll compare how they go for the year. All right, Fonterra. Farmers need some confidence, so I'm going to back you, farmers. And Hallenstein Glasson Holdings. New chief executive Chris Kinraid has come from KMD Brands, aka Kathmandu. Very keen to do an interview with you, Chris. There you go. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.